Hello and welcome into the KE Report. I'm your host, Shad Markowitz, and I'm speaking today with Jordan Roy-Byrne, founder and publisher of The Daily Gold. And we will put a link to The Daily Gold down below so you can follow along with Jordan's work. And Jordan, we definitely got to talk about the precious metals today because gold has been holding its own above $2,000. If you think back just a month ago to the beginning of March, everybody hated the precious metals. It was down in the low 1800s. Just a month or two later, after a banking crisis, some OPEC hikes, and some concerns about the Fed getting near the end of their hiking cycle, we now see a pretty robust precious metals market. What is your take on the price action in gold? What levels are you watching?
Well, I'm watching the weekly close. I would say that's going to be interesting. I mean, last week, of course, we closed at a new quarterly all-time high by about $30, new monthly all-time high by less than $1. And the same thing, the weekly close was the second highest weekly close ever. I was just looking at the chart. 2030 or 2028 is the highest weekly close ever. So that's something for listeners to keep in mind as we finish this week. On a very short-term basis, gold has broken out from if you're looking at the hourly chart, it's an ascending triangle pattern. And depending on how you measure it, I think the upside targets are you have a minimum of, I want to say 2060 or 2080. That's one pattern. Now, if you look at just like a 2-month chart and you go back to that February high and that decline, there is a potential really strong cup and handle pattern there. Now, you have to look at like a 2 or 3 month chart to see it, because if you look at a 1 year or a 2 year chart, it looks too vertical, much more like a sharp V than a U, the cup and handle. And I say potentially because it's possible. It hasn't really been proven, and that has upside targets, I think, in the 2100s, again, depending on how you measure it. I think right now, as far as today, there is some daily resistance at 2040, 2050. But yeah, based on the ascending triangle breakout on the hourly chart, I do think we're going to see gold probably run to 2100. And that could be triggered if it closes above the 2040, 2050 daily resistance. I mean, that's what's keeping it back today. As far as silver, I think if it does run above 2100, then silver can probably get to 27 or maybe a little bit higher. But if gold is not going above that 2080 level, then I think silver would not go above the resistance at 26. So silver is coming into that 26 to 28 resistance zone, and silver is outperforming gold, which is good. But yeah, if we can see gold move above 2100, then I think we're going to see silver at least get to 27. So yeah, the market's, I mean, it's pretty hot. It's definitely overbought, but I think we're probably, I should say the balance of probabilities still favors higher prices in the short term before a sustained pullback.
What would your take be, Jordan, if gold fails to make a new high and gets really close, takes everybody to the brink again, and then starts correcting back down? Would that concern you, or would you just think that that's normal to keep testing this level until it finally breaks through?
I wouldn't be that concerned. I mean, it's come up. Yeah, I'm just looking at the daily chart now. I mean, it's come up to resistance so many times. If you're looking at the daily chart, it's already very close to the 2020 and 22 peaks, even on a daily closing basis, that even if gold were to come back and correct, say to 1950, that would not impact anything at all. I mean, even if that lasted for a couple months, I mean, gold is it's really, really bullish here, and everybody knows it's going to break out at this point. So, yeah, I mean, if it took a couple months for that to happen, that really wouldn't concern me. I mean, if you look at the long-term moving averages, they're in the low 1800s. There's really strong support there, really good support at 1920 and 1950. But, again, just looking at this chart from a bird's eye view, it looks really, really good. So, again, it wouldn't bother me if it took a little time to break out. And at the same time, if it punches above 2100, it's still possible that you could get a snapback to 1920 or 1950. That could be the next correction. And the other thing, and I think I mentioned this in the past, is even though we're kind of overbought on a very short-term basis, like this early in these moves, you don't see the big corrections in gold bull markets. I mean, we corrected 8%. We just corrected 8% into that low in early March. So, yeah, as far as a correction, that's one that I could see. Somewhere above 2100, back down to 1950 or even 1920 perhaps. But other than that, I'm not worried about any big corrections right now.
Yeah, so more of a 2 steps forward, 1 step back, stair stepping higher as it blasts through, pulls back, blasts higher. With silver, though, I just want to go back to it. You had mentioned last week that you thought, the 26 to $28 range is some resistance for silver to work through. There is a lot of congestion there on the price charts, but it also got stopped out at 29 to 30, really, the $30 level over and over again. What will it take in the gold price, or what will it take for silver to finally punch through 30 and get up into the 30s, in your opinion?
That's a really good question. I would think with gold, let's just presume if we're looking at the next couple months, gold makes a breakout above 2100, but it does have some kind of snapback retest. If something like that happens, and then we see gold start to move back up after the retest, and then it really gains momentum from that point, I think that's a point when silver could pick up again and start this move towards 27, 28. Then there'd be enough buying, enough money coming into the sector to really push it past that resistance. Yeah, I mean, fundamentally, it's a little confusing because we're probably going into a recession, but at the same time, we're kind of in a stagflationary situation, but the rate of inflation is probably coming down, but it's still at a level which is too high for the economy, and still bullish for precious metals, and bond yields that are coming down at the same time. So it's fundamentally, I think the macro setup still favors gold more than silver. But again, if we see gold start to really gain a lot more momentum, if it's going above 2100 or 2200, I mean that type of scenario, you will see money come into silver, and eventually it's going to be able to break above that resistance. I don't know if I have a great fundamental answer at this point in time, but 26 to 28, if you're looking at weekly, monthly, and quarterly, that is pretty significant resistance. So the market has to be really strong to break through that. And, it's something where it could take some time. I mean, gold's in a much better setup here because the amount of resistance it has to deal with is like nothing compared to silver. But at least with silver, we know, we have this 26 to 28 level. So if this move that we've seen, if this continues over the days and weeks to come, we can look at that 26 to 28 and know that it's probably going to stop in that area, before it consolidates for a couple months or corrects.
Okay, appreciate you breaking that down. So it ultimately sounds like we just need gold to break out, not just to a new all-time high, but actually to get some momentum behind it and really start trucking, and that will bring more money into the whole sector and give silver maybe the impetus it needs to break through that stiff resistance, the $26 to $28 range. As far as the stocks, though, it has been nice to see not just silver outperforming gold recently, but also recently some of the stocks have been outperforming. Today's been a little bit rougher day, but in general, we've seen the stocks perform. What's your outlook on GDX or GDXJ?
Well, coming into the week, they were trading around some short-term initial resistance, and if they were to break that, they had about 12 or 13% technical upside. And so obviously yesterday, especially with GDX, they surged above the first resistance level. So looking at GDX, I see the next upside target around, I'm going to say 37, 38. And for GDXJ, in the 45 to 47 area. When you're looking at these targets, it's good to look at, in addition to daily charts, weekly and monthly. And so when you look at the monthly charts, you can see that these levels that I just mentioned, they really stand out on the monthly charts. So it makes sense that, okay, those are levels where we're probably going to see a pause for a couple months potentially. And that's probably going to coincide with $27 or $28 for silver. And one more thing I want to mention about the miners is, and I think I've mentioned this in past interviews, but looking at the advanced decline line and the rate of change on a 15-day and 25-day basis, It gives me, it's kind of my own custom bread thrust indicator, but looking at the last, 8, 9 years or so, and just looking at certain levels, there were two clear points that both these, 15-day and 25-day measurements for the advanced decline line, there were 2 points where there were clearly you could say it was a bread thrust, and that was in January 2016, and then at some point in 2019, I think July or June, whenever the Fed did that cut and gold broke out, and we've already triggered in the last couple of days the 15-day hitting the level that I look at, and the 25-day will probably hit that level soon when the 25-day is pretty strong, but the problem with the calculation right now is the day like 18 to 25 are negative, and so it's just a matter of time. And so over the coming days, we're going to see that bread thrust trigger. And so I look for both of those to go above these certain levels. So basically, we are going to see a bread thrust in GDX in the gold stocks. And so when you have that, it's not short-term bearish. So that's another reason why, looking at these targets, I think we're going to see miners continue higher before we see any kind of sustained pullback. I mean, sure, we're going to get, we could get a day or two or a few days of selling here and there, but in a short-term sense, there's a lot of momentum, and I don't see it weakening anytime soon, especially until we get up to those targets that I mentioned.
Well, Jordan, let's dig in a little bit more to the mining stocks because we hear a lot of monkey chatter out there from all angles. We hear some people saying that gold is making a new all-time high, then therefore, stock should also be making a new all-time high. But, they are different asset classes. We've also had fund managers come on and say every asset class should be looked at on its own accord, which I would agree with in theory, and that, just because gold is going higher doesn't mean that gold stocks should ultimately be at new all-time highs as well, because they are ultimately equities and they're tracking not just the price of the metals, but what's happening in the equity markets overall. And then we also hear the inevitable debate of, these things are just so undervalued. And you recently had a tweet out that garnered a lot of attention over on Twitter talking about the difference between cheap and undervalued. I'd love you just to maybe comment on how you're looking at how mining stocks are valued. Are they cheap? Are they undervalued? Should they be at new all-time highs? What's your take on that discussion?
I think they're cheap and inexpensive. I think those are the right words to use, because when you use value, you're looking at the present situation, and it implies that presently there is significant fundamental value based on the company's financials, their, or their assets, the profit potential there versus the current metals price. So looking at cheap versus undervalued, a lot of people will post, gold stocks divided by the price of gold, those ratios where they're near all-time lows or multi-decade lows. And the reason they're at those levels, and again, we're talking about the whole sector, the reason they're at those levels is because the margins and general profitability of the industry historically really low. If you look at the gold price right now, just compare it to the gold price 2.5 years ago when it was last at these levels. Costs have gone up significantly since then. If your all-in cost was $1,000 then, generally it's probably 1,300 now, or maybe it's 1,400 or 1,250. I don't know, but you get the point. Just if you're looking at the average mine today versus 2.5 years ago, the margins are much worse, and that's why the stocks versus gold are so low. And not only compared to 3 years ago, but also compared to 10 or 12 years ago. I mean, you could do the same calculation 12 years ago. I mean, that's the reason why gold stocks relative to everything are so cheap and why they're down so much off the all-time high, is because the gold price is basically the same as it was at the 2011 peak. I mean, that 12 years since then, costs have gone up significantly, if you think about it like that. So yeah, I think the distinction between value and cheap is really important.
Well, Jordan, let me ask you about this because, if you think about the universe of gold stocks, they're not all the same. A producer is totally different than a drill play, which is totally different than a developer. So when you think about there being almost 1,000 drill plays that don't have anything in the ground to show for it, maybe they have some good drill holes, but they don't have a resource yet. They don't have economics. That's a lot different than, let's say, a developer that has proven out a certain resource and, maybe they've got an economic study that shows a certain NPV and IRR and certain payback period. Aren't those two, apples and oranges? To say that the whole sector is undervalued is a bit of a stretch, but you could argue that maybe some companies individually, if you dive into them, are undervalued. What's your take on that?
Yeah, I mean, I think you're giving a much better answer than me, but that's an important takeaway, with this distinction of cheap versus valued. Yeah, and one reason why undervalued is the wrong term to use is because that implies that there's real economic value at present, which in a lot of these cases is not, because there's so many companies that really have no economic value. I mean, Rick Rule talks about this all the time. And I think you mentioned there a really good point, which is if you're looking at certain companies, I mean, that you could have two companies that are priced similarly, but one has better assets, or they've done economic studies that shows their economic value, versus something that really doesn't have that much value, and it might have been pumped up by whoever, or the market is just mispricing it. So like you could say that stock is cheap, whereas the other one is undervalued, because at present there's real value there and economic potential.
Well, Jordan, just kind of a final thought on this. When you look at the price action in gold recently, and the mining stocks and silver have also responded. And really, if you look back over the last 6 months, it's off the bottom in September for silver, and for the mining stocks, they've had a pretty big move. Things are short-term overbought, though. So for people that have been on the sidelines and maybe they feel like they've missed this move, how would you be allocating funds if you had some cash and you were looking at the sector? Would you be jumping in here? Would you wait for a pullback? Would you wait for a breakout? How would you be looking at it if you wanted to add to positions, but you didn't have big positions at present?
Yeah, really good question. It just depends on so many factors. I mean, it depends on this particular person, what are their financial goals and risk tolerance and all that type of deal. So it's tough to give a blanket answer, but I say this frequently. Look at things on a case by case, stock by stock basis. You don't want to buy something where the chart looks like a rhino horn, where it's gone straight up. Well, at the same time, you don't necessarily just want to look for stuff that hasn't moved, because a lot of that stuff is probably going to continue to lag for a while for fundamental reasons. Generally, you're probably going to find more value in silver. I think that's one thing to consider. In addition, there's always going to be pullbacks. So I wouldn't worry about feeling like you have to buy in immediately at this moment. I mean, we've talked about these resistance levels in GDX and GDXJ. There's monthly resistance there. So when those levels hit, there's probably going to be a pullback. Certain stocks will pull back more than others. And so again, you have to take it on a case by case basis. And, there's certain things that you might be able to buy in the coming days, whereas, other things might be a better buy in 2 or 3 months from now.
Well, Jordan, just one last thought on this idea, and that is we've talked in the past about the larger cup and handle pattern and what the price projections move up to. So if gold is in fact in a new secular bull, if it is going to start breaking out against other asset classes, other currencies, other equities, and if it's going to make that move like the cup and handle projected, maybe just for people that feel kind of sad that they've missed this recent run, map out how you'd expect, I guess, the minimum upside targets on a true breakout and a true secular bull market in the precious metals.
Yeah, the minimum upside target, or the measured upside target from this cup and handle, is 3,000. And so when you see a lot of people talking about 3,000 or 28 or 2,900, that's based on the cup and handle in the first target. Now, there's also what I call the log target, which is you're basically taking the depth of the cup and that percentage and then adding it. And historically, I've looked at major cup and handle patterns. There's not that many in significant markets and asset classes. And in all of those cases, the market has gone from the measured upside target to the log target within 6 to 12 months. And that the log target for gold, you're getting pretty close to 4,000. And, I looked at the rate of change of gold in the 2000s over like a 2.5 or 3 year period. There were multiple times in the 2000s when gold went up, I think it gained 90% over a 2 year period. And of course, it did a lot more in the 70s. But I think those two cases, it doubled in 2.5 years. And so if you just take the low in gold, 1630 or whatever it was, and you take 2.5 years, you're looking at almost 3,500 in what year would that be? Early 2025. And the fact is, the breakout from this cup and handle pattern, the setup is more bullish and the move is going to be a lot more powerful than what we saw in the 2000s. So, based on all those things, I think we could see $4,000 gold before the end of 2025. So, I mean, we are at the start. Like if we're just looking at the next 2 or 3 years, we're in the top of the first inning of a historic move. And look, I know that people have been hearing this from gold bugs and gold bulls for years and years and years, but this is something I've been writing about for the last 2 years, that this is a really bullish cup and handle pattern. I mean, when a market like this is breaking out from a multi-decade pattern or a multi-decade base, I can't underscore how bullish this is technically. I mean, this is one of the best setups technically that gold has ever had. I mean, it might be the best ever, to be honest. So when I say these things, I mean, I've been doing interviews with you guys for years and years. And I've mentioned like, yeah, cup and handle, when we get to that point, it's going to be really bullish. We're at that point now where this move is just starting and just getting underway. So, I mean, potentially there is a lot more upside here over the coming months and over the next 2 years. So, I mean, if you're just getting into this now or, you still have losses from the last couple years, don't worry about it because you're at the right place at the right time. And this should be really exciting for people who are invested in this sector. Finally, I think we're really going to see it here over the next couple years.
All right, Jordan, we'll wrap it up there. But yeah, just some thoughts for investors that maybe feel a little FOMO and, they feel like things have run too far too fast. There's still a lot of room to run in a true secular bull market in the precious metals. And if we get up anywhere near the $3,000 to $4,000 targets, as you outlined from the cup and handle pattern, the mining stocks are going to have plenty of room to run during that period, and so will silver, and so will the silver stocks. So we'll keep our eyes peeled for the short-term wiggles and squiggles, but sometimes it's nice just to zoom back out and remind people that, it's a long-term bullish picture setting up here, and there's still plenty of time to make some very nice gains, maybe life-altering gains over the next few years together. Jordan, always appreciate you spending some time with us here at the KE Report, and looking forward to our next conversation.